Welcome to ETF Edge, your go-to place for all things ETF related. I'm Seema Modi, filling in for Bob Pisani, and there's no shortage of telling signals coming out of China over the last week as the world's largest economy remains on rocky footing between manufacturing data missing the mark, retail sales coming up short but still rising at their fastest pace in more than 2 years, not to mention major China tech earnings from the likes of Baidu, Tencent showing signs of life after a challenging 2022. So how are investors ready to play the reopening story? Let's ask three experts in the ETF industry. Brendan Ahern, CIO of Crane Shares, Will Ryan, founder and CEO of Granite Shares, and Todd Rosenbluth, head of research at Verify. Great to see you both. Brendan, you've been watching these developments so closely. What are you seeing right now?
Yeah, we're seeing an incremental rebound from the Chinese consumer, Seema. It's not like turning on a light switch. That consumer confidence needs to grow after this zero COVID world. So we're expecting that Q1 will be better than Q4, Q2 better than Q1, and so on and so forth. That this slow incremental rebound as consumer confidence builds should help the consumer kind of come back. And we're actually hearing that from many of the companies that you mentioned in the management calls. They're speaking to how Q2 already is outpacing Q1, which outpaced Q4 of last year.
Let me bring Todd into the conversation. A handful of emerging market ETFs, Todd, have seen strong inflows lately, but do you get the sense that some investors are starting to siphon out of non-China EM bets from an overall emerging market allocation?
Well, yeah, we're seeing strong interest in emerging markets. Many advisors are telling us at Verify that they're looking to reduce their home bias, add exposure to emerging market ETFs. So the Vanguard FTSE Emerging Market ETF, VWO, the iShares MSCI Emerging Markets ETF, EEM, that's seen some relatively strong growth in net inflows this year. And as Brendan referred to, China is still the largest market. About a third of the overall assets are tied to it. One thing that we're seeing that's interesting is Crane Shares recently launched a income-oriented version of their KWEB ETF. The ticker on that is KLIP, CLIP. And we're seeing strong interest in that. People are looking to reduce the volatility in their China-dedicated exposure, and CLIP is a great way of doing that.
Okay, let's talk about crude, Will, because prices have ebbed and flowed on these China headlines. What are you seeing in oil right now?
It's pretty lackluster, to be honest, at the moment, because the market is really suffering from this malaise around the debt ceiling. And I think until we get clarity around what's happening with that, it's going to be difficult to see an upside move in oil or most commodities, to be honest with you. But getting past that, crude, I think the story is really largely based around the forecast for China for the rest of the year. We saw some good numbers coming out of the country in March, but I think as you've heard from Brendan, that this coming from such a low base, the recovery there is not going to be a linear recovery. And we saw good numbers for March, but the Chinese consumer used to be, or the traveling class used to be the most lucrative in the world, pre-pandemic in 2019. That hasn't rebounded. Domestic travel rebounding, which is using or consuming a lot of oil, but we've yet to see that from the international sector. And I think it will come, but maybe just not yet.